Build your dreams, live rich, and leave rich.
Hello and welcome. Today we're going to pull back the curtain on a world that, let's be honest, bombards us every single day with promises of quick money and a glamorous lifestyle. I'm talking about the world of trading. But what's the real story behind all that social media hype? What is this business really? And how does it actually work? Well, let's find out together. Welcome to Live Rich and Leave Rich. My name is Krish, and my one and only goal here is to give you the clarity you need to make good, solid financial decisions for you and your family. And today, we're going to cut through all that noise and confusion to really, truly understand what trading is all about.
You know, before we really get into the thick of it, I want us to just ground ourselves in our core philosophy here. To live rich, it isn't about the fastest car or the most expensive holiday. It's about achieving financial peace. I want you to hold on to that idea of peace in your mind as we step into what is often the very chaotic and high-stress world of trading.
Okay, now for a very, very serious and mandatory point. Everything we talk about today is for your education only. The data from our market regulator, SEBI, isn't an opinion, it is a hard fact. It shows that approximately 9 out of every 10 people trading in the futures and options market lose money. Let me just say that again so it sinks in. 9 out of 10 fail. This is not a game. The odds are seriously stacked against you. So please, always consult a SEBI-registered financial advisor before you ever make any decisions with your family's hard-earned money.
All right, let's get into it. Here's our game plan for this explainer. First, we're going to tear apart the social media myth from the actual market truth. Then, we are going to nail down the one critical difference between trading and investing. Trust me, it's a concept that changes everything. After that, we'll roll up our sleeves and look at the actual mechanics of how trading is done. Then, and this is the most important part, we'll cover the single most important safety rule. And finally, we'll wrap it all up with the key takeaways you absolutely need to remember.
All right, first things first. Before we even dream of looking at a chart or talking about a strategy, we have to address the elephant in the room, right? And that's the massive, massive gap between what trading looks like on Instagram and what it's actually like in real life. Let's tackle this fantasy head on.
Come on, you've seen those posts. I know you have. Some influencer sitting on a beach in Goa, laptop on their knees, flashing a screenshot of a 1 lakh rupee profit for the day. And they tell you, it's so easy. Just follow my signals, buy my course, and you can escape the 9-to-5 grind. But let's just pause and use some common sense for a second. If it was really that simple to make lakhs of rupees in just a few hours, why would anyone do anything else? Why would engineers study for years? Why would doctors go through all those years of grueling residency? The simple, unfiltered truth is that this picture, it's just a marketing gimmick. It's an illusion, and it's designed to sell you a dream, not to show you the reality.
So here is my promise to you. Just give me your undivided attention for the next 25 minutes or so, and I will show you the raw, unfiltered truth. No hype, no Lamborghinis, none of that. We are going to explore the real difference between a trader and an investor. We'll look at the exact mechanics of how trades are actually placed and managed on Dallo Street. And I will share the one safety rule you absolutely must know to protect your family's savings. I promise you, by the end of this, you will have clarity.
Now, we come to what I believe is the most important idea in this entire explainer. Just for a moment, forget about strategies, forget about charts. To get what trading is, you first have to grasp the huge difference in mindset between a trader and an investor. See, they might be standing in the same market, but they are playing two completely different games with two completely different sets of rules. Let's use an analogy to make this crystal clear. Think of an investor as an orchard owner. They buy a piece of land, they buy a tiny mango sapling, they plant it, and their whole vision, it's for the next 10, 15, even 20 years. They water it, they nurture it, they protect it from pests. They don't panic if it doesn't rain for a week or if there's a small storm. Why? Because they're focused on the long-term health of the tree. They know that one day it's going to grow into this massive, strong tree that gives them and their family a lifetime of fruit. Now, a trader is completely different. Think of them as a wholesale vendor in a market. This person wakes up at 4 a.m., goes to the mandi and buys 100 boxes of mangoes for, let's say, 500 rupees a box. Their entire world, their whole focus is squeezed between the market opening at 9:15 a.m. and closing at 3:30 p.m. They don't care about the orchard, the farmer, or what next year's crop will be like. Their only goal is to sell those 100 boxes for 505 or maybe 510 rupees before that market closes for the day. They are in the business of capturing that tiny price difference today. You see? Investing is passive wealth creation. Trading is an active, high-stress daily business.
Okay, so the mindset is clear, right? We're the wholesale vendor, not the orchard owner.
So now let's get into the actual mechanics. How does this business of trading really work, day to day, on the National Stock Exchange? What are the tools and the techniques that they're using?
So, the most common style you'll hear about is intraday trading. You'll often see this listed as MIS on your broker's app, which just stands for Margin Intraday Square Off. The name tells you everything. Intraday means within the day. You might buy a stock at 10 a.m., and you absolutely must sell it before the market closes that very same day. You never actually hold the shares overnight. Now, here's the crucial rule in the Indian markets. All your intraday positions must be closed before 3:30 p.m., and if you don't sell it yourself, well, your broker, whether it's Zerodha, Upstocks, whoever, will automatically force sell your position for you, even if you're in a huge loss. The clock is your boss. There's no waiting and hoping it will recover tomorrow. The day ends, the trade ends.
Then there's another popular style, which is a bit less frantic, called swing trading. Here, a trader might spot a stock that's been trending upwards for a little while, and they believe that trend is going to continue for the next few days or maybe even a couple of weeks. So they'll buy the stock and hold on to it to capture a bigger price movement or a swing. For example, buying at 100 rupees and aiming to sell it at 115 rupees 2 weeks later. But here's the key point. Even though they're holding it for weeks, their goal is exactly the same as the intraday traders. It's all about profiting from a price change. They're not looking to own the orchard, they're just trying to profit from a seasonal price swing.
Okay, so if our wholesale vendor isn't spending time reading a company's 10-year business plan like our orchard owner is, then what on earth are they looking at? Well, they're looking at charts, and their number one tool is something called technical analysis. Let's break down what that really means in simple terms.
Forget all the complicated jargon for a second. At its heart, a stock chart is actually incredibly simple. I want you to think of it like a heartbeat monitor in a hospital. It's not measuring the financial health of the company. No, it's measuring the collective pulse of human emotion in the market, second by second. When you see that line on the chart going up, what does that mean? It means greed is winning. Buyers are feeling optimistic, they're excited, and they are pushing the price higher and higher. And when that line goes down, it means fear is winning. Sellers are panicking, they're scared, and they are pushing the price lower. A trader's entire job, really, is to read this emotional heartbeat and try to predict where it's going to go next.
Now let's zoom in a little closer on that heartbeat line. You see all those little red and green rectangular blocks that make up the line? Those are called candlesticks, and they are basically the language of the market. Each individual candle tells you the complete story of a battle. Within a specific period of time, let's say the last 5 minutes, it shows you exactly who won the war between the buyers, who we call the bulls, and the sellers, who we call the bears. A green candle, that's a victory for the bulls. It means buyers were aggressive and they pushed the price up. A red candle, that's a victory for the bears. Sellers were in control and they pushed the price down. And traders, well, they study the patterns of these little battles to try and guess who might win the next one.
Okay, this next concept, it's one of the most confusing things for beginners, but it's so important to understand how traders think and operate. You see, traders have this unique ability. They can actually make money even when the market is crashing, and they do this using a technique called short selling.
So how in the world can you sell something you don't even own? It sounds impossible, right? But let's use a really simple analogy. Imagine your friend has a special pen that's currently worth 100 rupees in the market. You have a feeling that the price of this pen is about to fall. So, step 1, you borrow the pen from your friend and you promise to give it back later. Step 2, you immediately go and sell that borrowed pen to someone else for 100 rupees cash. So now you have 100 rupees in your pocket, but you still owe your friend a pen. Step 3, just as you predicted, the price of that pen drops to 80 rupees. Step 4, you go back to the market and you buy the exact same pen for just 80 rupees. And step 5, you return the pen to your friend. And there you have it. You started with nothing and you walk away with a 20 rupee profit just by betting that the price would go down. This is exactly what traders do with stocks, using their broker as the friend who lends them the shares to sell first.
We have now arrived at the most important part of this entire discussion. You could master every single chart pattern. You could learn every strategy out there. But if you do not understand and live by this next concept, you will fail. This isn't about making profits. This is about survival. This is about risk management and your non-negotiable tool, the stop loss.
Let's come back to this number. 90%. 9 out of 10 people fail. But why? It's not because they aren't smart, and it's not because their analysis was always wrong. The number one reason for this shocking failure rate is psychology. It's the failure to control your own fear and greed. It's the lack of discipline to manage your risk. They are basically trading without a safety net, So when they fall, they don't just get hurt, they crash completely.
So what is this safety net? It's called a stop loss. And the best way to think about it is as your financial parachute. Let's say you buy a stock at 100 rupees and you're hoping it goes up to 110. But what if you're wrong? What if it starts falling instead? A professional trader, at the very same moment they buy at 100, also places a computerized sell order at, for example, 98 rupees. That is the stop loss. It's a preset instruction that says, hey computer, if I'm wrong and this trade goes against me, I want you to get me out automatically at 98. Limit my loss. It's your parachute that opens up by itself to stop you from a financial freefall.
And this right here is the huge psychological difference between a professional and an amateur. You see, professionals know they're going to be wrong a lot of the time. They treat small losses like a business expense, just the cost of doing business, to find the next winning trade. The stop loss makes sure their losses are always small, manageable, controlled paper cuts. But an amateur, driven by ego and hope, doesn't use a stop loss. When the price falls, they hold on, just praying for it to recover. And that small paper cut, it turns into a deep, emotional wound that can, and very often does, wipe out their entire trading account. So let me ask you, would you rather take a small, planned paper cut or risk a deep, unplanned wound?
Wow, we've covered a lot of ground here, haven't we? From the mindset to the mechanics to survival itself. So let's just boil it all down. Think of this next slide as your trading cheat sheet, the core ideas you absolutely need to take away from our discussion today. Okay, here are the 4 core concepts. Intraday trading, that's the business of buying and selling within the same day before 3:30 p.m. Swing trading, holding for a few days or weeks to catch a bigger price move. Technical analysis, that's the art of reading charts, which we now know are just graphs of market fear and greed. And finally, the most important of them all, the stop loss. That is your non-negotiable financial parachute. Of everything we talked about, please remember this one. It is the one thing that separates the survivors from the 90% who fail. It's the rule that protects you from a catastrophic loss.
So you see, the final question isn't can you make money trading? The real question you should ask yourself is this a business that aligns with my personal goal of living a peaceful life? Because it is a full-time, high-stress job that requires an immense amount of emotional control. For most people who are looking for long-term wealth, the peaceful path of the orchard owner, investing, is far, far more suitable. I really hope this brought you some clarity today. If it did, please subscribe and share it with someone who might need to hear this perspective. The link to the Legacy Diary is down in the description. Thank you so much for your time. And remember, to live rich and leave rich.